Hello and welcome to Investing Confidential. CPI came out. If you've been watching my videos, I told you that this CPI has peaked, inflation has peaked. Market is this bear market rally is continuing as we discussed. The question is, how long is it going to continue, and what really is inside these numbers? Is it really as dramatic as it's saying? We're going to look at that right now. And I think the most important part, or for anyone to understand these, is to look at the actual numbers themselves. So here we go. Let's go right to the numbers. Here we're going to go on to the Bureau of Labor Statistics website. This is what the brokers are not going to show you. We're going to go right to the numbers. Okay, this is the CPI index. This is what everyone looks at. This is what they interpret it their own way. But we're not going to interpret it. We'll just look at facts. Okay, it increased by 7.7%. This is what the numbers say. They talk of this. This is what, by the way, this part of the press release is what everyone focuses on. Right? This is the worst. This is not the part to focus on. It's underneath. But so they're going to show you increase 7.7. Oh, all of a sudden the bots are coming out better than expected. The market's going to rally, et cetera, et cetera, et cetera. Okay, but let's go through these numbers. Okay, here we go. This is the raw data. So as we can see here, these are the numbers from April to October. October is what everyone's focused on. Okay, so let's go through some of these. Let's look at food. Okay, food inflation, especially food at home, right? This is food you buy. Folks, we're talking up so far this year, almost 11%, a big rise of 0.6%. Again, this is declining slightly, but it's not declining that much. Okay, so when we look at when the talking heads tell us that inflation was 8% or 7%, it was really, food. Everyone needs food. Okay, this is what's really hurting people. Okay, look at this. This is takeout food away from home, going to restaurants, 12.4%. This isn't coming down that much. It's declining, obviously. It probably may still decline, but I'm going to show you why, as I was saying before, this is sticky inflation. Let's look at energy. People have to use energy. Look at these energy numbers, almost 18%. This number is increasing. So they're telling you that inflation's coming down, and I'm going to see the numbers of the reason it's coming down. But yet you've had a massive move in energy. So the common person, that means everyone in the United States with the exception of the elite, okay, they're not suffering. But man, this is a big increase. Okay, gasoline, all of these things, these components, fuel oil. Imagine if you're in the Northeast. You're up 70%, up in October, 20%, almost 20%. If you're in the Northeast, your fuel oil prices are 20. And by the way, the reason that people are still using fuel oil is because the politicians do not want to build any more gas pipelines. Okay, and the gas pipelines we do have are being shipped overseas, and I'll show that in a second. So again, energy services down. Okay, that contributed. Look at this. Gas prices were down huge, down 4.6%. Guess why? Okay, we look at this trend of these gas prices. This is all about shipping gas to Europe. Okay, and now European gas prices have plummeted. So now we're starting to keep some of the gas back for us, and we got down. But look, it's still up 20% for the year. Let's look at some other things here. Okay, we're looking at commodities, et cetera. Okay, this number is coming down slightly. New vehicles still sticky, but coming down. But here's the big one: used car. Now, if you were watching my videos, I've been telling you used cars are plummeting. The dealerships, up until recently, have tried to tell you that used cars you're going to pay a premium. This has never been the case. This was artificial, and now you're seeing finally. These prices come out. You're going to see the same thing in the new vehicle prices. They've been up 8% for the year. We're going to probably see this over the next 3 months start to come down very hard. Okay, now we'll look at some other things. Shelter. This is again housing. I told you, this is a lag. Housing still rising. Okay, relatively speaking, up 7%. But this is going to start to come down. So again, some stuff comes down, some stuff continues to go up. Transportation is coming off after being up quite a bit. But now again, this is what talking about digging through let's look at some of the data here, or some of the commentary. Okay, so look at this. Food index increased, okay, in October following. Okay, so it's less than it increased the following month. 4 of the 6 major grocery store food groups increased over the month. Okay, again, look at this. The index for meat, poultry, fish, and eggs rose 0.6%. That is higher, okay, than the overall food index, meaning the stuff that you eat, that everyone else eats, that most of the people buy, is going up. The big move down in the food index was fresh fruit. Okay, fresh fruit prices fell 2.4%. I can't tell you why. Maybe it was overproduction. I don't know. But again, this is a false thing. Look, I wish people would eat more fruit than proteins, but obviously, everyone's in this category: meat, poultry, fish, eggs. This is where most of the money goes, even for bakery goods, up more than the overall. Yet the index will tell you that food is coming down, but it's not. It's just fresh fruits that had a huge, cyclical down move for the month. But again, that's not going to continue. Okay, so let's look at this. This is food away from home. This is food service. This is going out to restaurants, et cetera, et cetera, et cetera. That was up almost 1%. Okay, pretty significant. Food at home index, takeout, whatever you want to call it, up 12.4% over the last 12 months. This is massive, folks. Cereals, bakery goods, 15.9% over the last year. What this is telling you is that inflation has been higher than the index tells us, number one. Number two, it's coming off, but it's not coming off as much as the talking heads want to tell you it's coming off. Again, we look at energy, some of the details over energy. Gasoline rose 4% month on month. That's a big move. Okay, we saw declining gasoline prices. These were artificial. I'll go into that later. Artificial because of the government using strategic oil reserve as a tool for inflation, which is not supposed to be. But that's come down, right? So now they drained it to a point where they can't drain it anymore, and now we got gasoline prices rising. Right? That's not good. Again, this takes money out of people's pockets. People got to put gas in their cars. So, again, look at this index, up almost 18% over the last 12 months. They've been telling us that inflation has been, 7-8%. It's actually 18%. It's actually significantly higher than it has been, than what the index tells you. Okay, we can go through all these things, but again, we talked about food. It's really fresh fruit that drove everything else is going higher. Medical care fell. I don't know why medical care fell. I have no idea why, but it fell. So overall, it's a mixed bag. Okay, sure it's lower, as we said it's going to be lower, but there are other things that are very sticky. Okay, and at the end of the day, all of this stickiness is going to lead to a inflation rate in the 4 to 5% range, which historically is very, very high. So let's discuss some of these other figures that are out there that are contributing to this, and also really what's really important to people. Again, I mentioned the strategic oil reserve. See, you can look at it. I mean, they've drained it, folks. They have drained it to the point where it's dangerously low. And it's not dangerously low because we needed to drain it. It was because it was done for elections. Now the elections are over. They're not going to drain it as much anymore. Okay, we're sending natural gas, all of our natural gas that burns cleaner than obviously fuel oil. And that's what people don't understand. There are still so many houses around that use fuel oil, and those prices are skyrocketing. Northeast, Midwest, because there's no pipelines, there's no gas supply. And it's even worse now because we've been shipping it to the EU. But that's going to end now because the midterms are over. Okay, that's the realization. And we're going to see start to normalize a little bit. But folks, we're going to see energy prices continue to be very firm, obviously depending on the weather. Now let's talk about real estate. I mean, I talk about real estate almost every video, but you have to, because this is really an important part of everyone's health and well-being in the future. Okay, let's look at first supply, new supply versus existing supply. Okay, these things are going up. Okay, there's no doubt new supply will come off a little bit because home builders are just there's no demand, so they're going to have to stop building at some point. But existing supply is going to start going up pretty dramatically, I think, over the next 12 to 18 months. And remember, we talked about this. Real estate takes time. It goes up real fast, but it takes a long time to go down. Let's look now at existing home sales. Again, falling faster than during the great financial crisis. So, I mean, this is natural, right? The reason they're falling is there's no buyers. Okay, there's no buyers, and the sellers want to keep their prices up. So consequently, sales are falling. You're going to see the break eventually. Somebody's going to hit a bid. It's most likely going to be these institutions who are choking all this inventory, not individuals, but institutions who are levered. I spoke about this before. I'm not going to go through who they are. You can look back at my past videos and see that. But existing home sales falling faster and you're going to see prices follow this. Okay. Now here's the big one: housing affordability. This is a negative figure. It's at all-time highs, meaning it's unaffordable. I mean, it's worse than the great financial crisis. You cannot buy a home right now. Prices are still high. This tells you that the prices have to go lower. People are not going to step in to buy homes. They're not going to bail out the big hedge funds and the institutions who cause this problems. These guys are going to puke out, and the prices are going to come tumbling down, and then you're going to get affordability back, and people will come in. Let's look at here again. This is just evidence of what I've been talking about: housing equity versus. So there's theoretically a lot of equity. Okay, mortgage prices versus equity. There's a big discount here. People are going to lose this equity. Okay, that's the bottom line, because mortgage, if you want to take out a second loan to take out your equity, now mortgage price is 7%. It's not economically sound to do it. So the equity is going to tumble, okay, unfortunately for most people. Here we look at U.S. home prices versus mortgage rates since 1987. This is a staggering chart. It shows you how overvalued, again, more evidence on how overvalued houses are. And again, tells you that home prices are going to come down. And the catalyst for this is going to be inventory coming on the market, not from people, but from institutions who have been buying houses sight unseen. They have no idea what they own, no clue, except now that their whatever inventory they have is down 10, 15%, they're going to have to puke it out. Okay, and that's the opportunity. So again, housing prices are way out of whack. Now I want to get to some other interesting, some charts here that I think are really interesting. Let's look at, again, all we're talking about is recession and slowdowns. Let's look at the recession during presidential cycles. So next year will be the third presidential year of the Biden administration. And as you can see, we've never really had a recession during this third year. Do we break this trend? I would bet yes. I'm always a contrarian. The administration is going to tell you no, but I would bet yes. But it's interesting to see this, that we've never had a recession during, or at least a state of recession during the third year of a presidency. Now, some really absurd information. Again, we talked about this. It's this Atlanta Fed manipulating GDP, telling us GDP now, or in their GDP now, we're going to see 4% GDP next quarter. I mean, this is garbage. This is absolute garbage. The reason we're seeing things come down, okay, from a standpoint of CPI, is not because inflation is easing. It's because the economy is slowing, folks. It's dramatically slowing. Housing, demand for everything is falling off a cliff. And there's no way you can manipulate GDP all you want. So just like they manipulate all the other numbers, just don't believe it. This is absolute garbage. And here's reasons why, that the risk to again, this is more of a medium term statement, but the risk to this economy, to the world, is global. And the risk is deflation, is recession, it's depression. It's not this inflation, okay? We're going to get through this inflation, but unfortunately, it's going to lead to something even worse, okay? China PPI is a leading indicator for everything. And as you can see here, it's plummeting, okay? China's got major, and this is a problem of demand, major problem of demand, okay? And this is what causes major slowdowns and recessions. China's got a huge demand problem. And I'll tell you why in a second, but I think you all know why. And then it's going to follow here with the US. Okay, what does that mean? That means lower inflation, folks. Lower inflation, lower headline inflation. I keep telling you, inflation will be sticky because of all the money we've printed. It will stay around 4%, 5%, which is historical high. But things are gonna come off. And again, to follow up on China, this zero COVID policy is not going away. Do not believe the talking heads. Do not believe the rumors out there. It is a nightmare, okay? It's now in Guangzhou. And I don't know if many of you know about Guangzhou, but Guangzhou has been the export engine of China for 30 years, okay? Even before this big boom in China since they went to WTO. China's where, but everything used to be all the cheap manufacturing, all the shipping, all the exit. Guangzhou has all of the not the tech entrepreneurs, but the real entrepreneurs that built all these businesses. All came out of Guangzhou, okay? And Guangzhou is now shut down because of COVID. This is dramatic. Okay? This is one of the most important cities most people don't know about. So this is going to affect massively the engine of China, the growth engine of China. And so zero COVID is not going away, and we're going to see the effects globally, and we are seeing the effects globally. Another, again, just to enforce my point, look at ocean freight from China. It's literally gone. Okay, this is stuff shipping now. During normal times, China ships a ton of stuff here, but there's no demand here. There's no demand there. There's no demand here. So so consequently, shipping rates and traffic is just plummeted. And here, look at trucking rates. Again, trucks. I keep saying this. Trucks are the engine of this economy, of every economy. Goods don't move around unless they're moved by trucks, especially in this country. Trucking rates going down, meaning there's no demand for goods no demand for goods. That is a leading indicator for a recession. We are in it right now, but the numbers don't tell us. But this is something. These kind of indicators you have to look at. So let's go back to what's happening today in the market. Big rally, as we discussed. We had the three catalysts. We had the midterms, which are now over, and most likely we're going to get gridlock now. Pretty sure we're going to get gridlock. We've got Ukraine heading to the peace talks. They have no other choice now, especially since most likely the Republicans will have both. At least they'll have the House, but certainly it looks like they're going to have the Senate as well. But even with the House, they're going to stop all this Ukraine money going over, and then we have the CPI, which we discussed. All these three, everyone was bearish. A lot of puts, very few calls. Boom, the market's rallying. This is a bear market rally. We discussed it before. It's a tradable rally. If you're in there, wonderful, keep riding it, but just be prepared to put your stops in and get out, because this is a bear market rally. And when I say bear market, I really love this chart here because it really shows you what a real bear market is. So the longer chart is really the tech industry after the tech bubble burst. And the tech bear market lasted for a very, very long time. And you put now what's happening to our market today, and we're following a very similar pattern here. We've had a boom, we've had a bust, and I believe we are in for a protracted bear market. That doesn't mean you can't make money in the stock markets. That means you just have to know what you're buying. You can't buy indexes anymore. I'm sorry to say, you can't buy, you forget about ETFs and mutual funds from your broker. You need to do some homework. You need to look for individual companies, and that's where you're going to make money. This is going to be a great market for stock pickers. but a lousy market for people who just want to have exposure, because we're going to be in a protracted bear market. And finally, some interesting things to look at here. I think one of the outcomes of all this will be, as I said, I'm really, really bullish on developing countries. I think emerging markets, bonds especially, could be a buy here. The flows have been, flows are negative, as you can see here. That means people are puking out this stuff. They're panicking. The yields are very high. And I wouldn't suggest people buying individual bonds. Stocks are different, but you can find some ETFs or funds, the good quality ones. Make sure there's good track record, because I think there's some very again, you're looking for high yields. You're looking for stuff that's going to really, I think you can get close to 10% now in some of these bond funds. But I think we're going to get into a very interesting situation in developing countries, specific developing countries, not China, but others. And so this could be an interesting option. So again, big rally. It's a bear market rally. If you're a trader, enjoy it while it lasts. But if you're an investor, as always, be careful out there.